This is me. Just a very quick introduction. I'm the MD and Head of Sales and Distribution at SDAX Minterest. I spent 12 years with investment banking and then 10 years with a real estate company in Singapore, heading up their Indonesia business. So I have both financial investment banking background and real estate. Who is SDAX Minterest? I believe some of you may have gone to our website, but just in a nutshell, we are basically a regulated exchange where we have a twin focus of real estate and ESG deals. And our plan is to be the ecosystem that connects companies to capital and investors to alternative investment opportunities. We believe that we can do this well by democratizing finance through our tokenization model. We are backed by very strong strategic shareholders. Straits Trading Company, those of you who are Singapore-based will know that they're a large conglomerate investment company with a focus on real estate and hospitality. ARA is now part of ESR, one of the largest real estate manager in the world, and they have a strong focus on the new economy and expanding their presence within Asia, Europe, and the US. PSA is Singapore's leading port group, has a global network of over 50 locations all over the world. So they are very much into logistics and affiliated business to their ports. RHT is a law firm and they started SDAX a few years ago before we merged with Minterest. So we were very happy to announce that we closed Series B funding in December, where we raised 24 million from 2 to 3 shareholders, led by Straits Trading and PSA, and we are currently very well funded. Now, what does it mean for us to be focused on real estate and ESG? Basically, given our parentage and our sponsors, we believe that we have, one, very good access to real estate ideas and deals, and real estate has traditionally been a very large, chunky, illiquid asset class. And what we do is we are able to fractionalize the ownership and basically enable more investors to participate in these large ticket investment ideas within the real estate sector. We will give you more examples as we go along. On the ESG side, we are committed to working very closely with companies and partners to create value through its sustainability goals and to support innovative solutions. These will also be part of our unique selling point, and again, we will showcase some of the ESG deals that we have done in the past. So ESR, I think, really doesn't need much of introduction. They're one of the largest real estate manager in Asia Pacific. They are very much focused on the new economy and prime commercial sectors. I think let's jump straight into overview of the real estate sectors that has been prepared by Dr. Chua. I'm very pleased to introduce Dr. Chua. He is the Group Head of Research and Analytics at ESR. Prior to this, he has spent some 20 years in research covering planning as well as consultancy and commercial work. So without further ado, let me hand this time and the slides over to Dr. Chua so that he can take us through some of his research and the trends that he sees for real estate. Dr. Chua, please.
Thank you, Sharon. Good evening, everyone. So I kind of put together some information thinking that, it's something that might set the right frame of mind in terms of investors, what we look out for in Asia Pacific. So we have 4 sections that we look at tonight. This quick overview of the APAC economy, and then we look at the real estate capital market before we dive into the investment opportunities. And all good investors we do always need to look at what are the emerging risks. Right? It is important to look at that whilst you invest. APAC economy, as many of you are quite familiar, the recovery has begun as early as 2020. In fact, with many Asia Pacific markets resuming some level of economic normality. However, this is quite uneven, and it's largely due to the disparities in the vaccination levels, as well as the management of the pandemic domestically in the market, as already seen. The initial rebound was quite quickly followed by a marked retardation, as you can see on this chart, right? Because it's really due to the weak global demand And many of you have heard it before, the same storyline, the supply chain disruption that followed. And now it's a geopolitical conflict that is arising in Europe. And that has impact. In fact, the World Bank just cut the economic forecast in April from what used to be 5.4 for this part of the region to just 5%. And in fact, they have an expected possibly 100 basis points discount if the situation in Ukraine and Russia worsens. If you look at this chart, the China economy has been experiencing tardiness, right? So let me just explain a little bit how do you read this chart. It's quite busy. The gray colored bars are the year-on-year change, right, in GDP. That is the 2017 fourth quarter, 2018 fourth quarter, 2019 fourth quarter. And then the ones in blue, in the latest year, that is 2021, first, second, third, and fourth quarter respectively. The darker the color, the closer they are to our time horizon today, that is 2022. So if you look at the dark blue vis-a-vis the light gray, you see that across the region, most of the markets, that is Australia, Singapore, and South Korea, have largely kind of gone back to pre-COVID levels in terms of GDP economic recovery, except for China. I can say China's rebound was very strong towards the end of 2020. But since then, it has seen severe slowdown in the market to a point where it's not even reaching the pre-COVID levels. There's something to watch out as we invest and we look at the markets across the region. And this tardiness is really due to a few things that's happening domestically in China that you hear about. I'll go into that later. That headline numbers, the GDP shows some slowdown. If you look at some of the unemployment numbers, well, the fundamentals are quite strong. If you look at it, unemployment numbers are coming down, meaning there is a widespread economic growth across the domestic markets, across the whole region. You look at it, Australia, Indonesia, Japan, Singapore, and likewise, right? All the unemployment numbers are coming off, which is a good sign, meaning that, like I say, the economic fundamentals are strong. But however, these level of unemployment are still not back to the pre-COVID levels, which means there is still some lethargy in the economic factors. Although the bull in the market would say that, oh, this is pretty good because then if any runaway economic recovery, there is still enough buffer in the local domestic market to absorb the activities. But however, I like to look at the leading indicators. And for that, I look at the PMI. So the APAC PMIs for manufacturing especially are all in the expansionary zone that is above 50 mark, right? So the 50 mark is this line here. All the markets are in expansionary except in China again. And even then, for the other markets, Australia and Singapore, there is tardiness, right? Australia's PMI is expansionary, but it has been slowly coming off. Even though South Korea have seen 14 months of continual rise in the PMI. In the latest numbers in March, there is seeing some slowdown already. And this is really on the back of high inflation issues and supply chain as well. And this storyline is likely to continue going forward as we know about the supply chain disruptions, the high inflationary pressures that the global economy is facing. So weak demand, high inflation, this is a formula likely to continue to pare down our economic growth. So this PMI will kind of translate to weaker economic conditions in the next 6 to 9 months. Another factor that I'd like to look at is the fixed capital investments. Why do I look at this? Because this tells you the health of the midterm in terms of economic fundamentals again. So fixed capital investments are important because this will replace the obsolescence in the market. In the event of any upside in economic activities, right? Is there enough free play in the market to absorb? So if you look at the region, across Asia-Pac, all the markets are now paring back on their fixed capital investment, which means that should the market were to pick up in the short to medium term, or any further obsolescence to set into the real estates, into the factories, into the products and assets, the markets are unable to pick up eventually in the mid to longer term. So this is something to watch out for. If there's a prolonged slowdown, decline in this capital investment, it will inevitably impact the economic growth in the longer term. Of course, we all know inflation. right? We know inflation pressures has been rising and continues to rise, especially right now with the ongoing geopolitical risk. And why is this important? Well, especially for Asia, we are very export driven. So if you look at it, I will pay attention to where the US and European inflation is. As you all know quite clearly, the US and Europe are facing high inflation. And this is important because as a high inflation regime could result in definitely weaker economies, especially if their income growth lags, right? And in the longer term, this will have impact on us, the export dependent Asia. And the other thing to look out for is actually in the inflation, one of the other factors that we notice is the construction cost. And across the globe, this has been hardening on the back of supply disruptions, labor shortages, and material cost. So much that toner and tunnel sales have recorded increases in some markets of up to 40% in both steel, timber, and copper prices in 2021. So that has long-term impact on cost of construction and it will translate to a higher cost of our assets. So on the back of that, what happens then? Well, what's happening to real estate? The real estate market, interestingly, what happens to the real estate market? Well, despite all that economic rah-rah and then they kind of slow down, we find that the real estate capital market has been kind of insulated from all the issues. In fact, the APAC real estate market recorded an annual high. In fact, it's almost a historical high, right? In 2021, the blue bar, that is over 20. This is the first time we have seen 200 billion, in transactional volume in 1 year since the data started in 2007. So this phenomenon, and talking that this is in a COVID situation. So you can see the amount of liquidity in Asia. And if you look at the red bar, that is the amount of money that's being raised, and that can be read on the right-hand side of the chart. It's just slightly shy of the peak in this decade. That is 2018, that was about 25 billion. And in 2021, again, the amount of money raised in the private capital market is about 25.1, just slightly shy. And this shows the amount of money that is floating about in the market, both on the buyer and on the supply side of the situation. If you take a further look at that number, you get very interesting trends, right? So this dives deeper into where the asset classes are, what its behavior are. The grand total, nutshell, is 18%. What does that mean? Well, the overall market in Asia-Pac transaction volume is 18% above the 5-year average. And that's we're talking about in 2021, where economic conditions were weak, COVID crisis, pandemic, right? And who are the key drivers of this market? Expectedly, if you look at the year-on-year volume, other than the commercial, right? Just look at the commercial, the peak of the market, well, the hot favorite is, of course, industrial, 47%. A year-on-year increase. Of course, you have senior housing, that's 55%, but that's a non-commercial. That's more on residential. So we look at the commercial asset classes. The top of the market is industrial. We all know about that already. It is second after the office market. So despite all you hear in the market, industry is doing very well. In terms of total volume, total value of transactions, leading the market is still office assets, followed by industrial. And of course, the up and coming ones that you should keep a close watch on is definitely those in the residential market, the accommodation sector. So where the opportunity lies, well, I kind of alluded to that already. I think we all know that the new economy, right, as a result of the COVID, the social lockdown, actually this new economy has started way before the COVID. The repositioning, the e-commerce and all the activities started way ahead, especially we've seen the retail market scene has been heavily affected by the e-commerce. And if you look at the transaction volume, in fact, for industrial has been picking up as early as 2018 already, ahead of the COVID situation. And where the markets, top of the market in 2021, in terms of overall industrial assets, and here by industrial, we are looking at business parks, data centers, logistics, and other industrials. So here we classify them all as the new economy. I'm looking at Greater Seoul, The Korean market is top of the tip right now. Shanghai and Sydney, these are the top 5 markets in Asia Pac with tremendous growth that we're seeing in 2021, and that's likely to continue. Why do I say that? If you look at the regional e-commerce sales, this on this chart, you notice that APAC actually kind of leads the rest of the world, and this is really due to China's market. And some studies have shown that this is likely to continue. This trend is likely to continue to fire ahead, because if you look at the penetration in China, the internet penetration, it is still quite modest compared to, say, Singapore or Korea, which has very high penetration. So China, being a rising economy, as well as the rest of Asia, talking about Indonesia as well, these markets are huge. The penetration will continue to improve as more investment in infrastructure continues. And you're going to expect a lot more e-commerce activities in this part of the world. And on the back of this e-commerce, really, we're talking about all the things that you click and buy, right? And one of the strongest sector that we have seen, besides logistics that I showed earlier, which is all these asset classes, all these new technology, what among them, one of the key asset class that we are quite positive about is really the cold chain, the cold storage. And that's really because if you look at the behavior of the logistics right now, a lot of demand is coming out for fresh produce. Some of you might remember during the COVID when you had a severe lockdown, you were doing a lot of e-martings, you were going into red marts, right? Amazons and Prime and whatnot to buy your groceries. So that trend has been continuing here in Asia. A lot of demand for fresh produce, and also because of the vaccine, the demand for cold storages has picked up, and we noticed an asset class that we need to keep our tab on. In fact, in terms of some of our key sectors, this is one of the key ones that we are looking at seriously at the sector. Because you look at the rest of the logistics, the cap rate has tightened quite a fair bit in the last couple of years. And we think that right now, a lot of the purchases are more for land banking. But the cold storage is an area that is still quite substantial potential. And like I said, and it's really driven by because of two things. You have rising urbanization in Asia that's going to continue. As you move into the city centers, you're going to continue to demand for more fresh produce because you're further away from your agricultural land, and the continual rise in population growth in Asia. If you look at Asia population, you'll find that are very young. The median age is about 24, and except in Singapore and Thailand and South Korea, where it's aging, but the rest of the market is still very young. And that's where you're going to see a lot of demand. All these millennials, right? They are likely to continue to support the e-commerce sector going forward. So hence, we are positive on this factor. The other asset class that we are quite positive over is definitely the office sector. I think as mentioned from the transaction, you notice that office sector is still the key driver of transactional volume. So we're not throwing the office out with the baby, with the bathwater at the moment. If you look at the activities that's going on in Asia right now, face time is still quite critical. So we did a survey of our tenants across Asia Pac, and we noticed that those in Singapore and China, occupiers, tenants would prefer their employees return to the office as compared to see the Western market, say Europe and America, even Australia, where face time is not so important. So the whole work from home or the alternative work arrangement is a lot stronger there. And in fact, this survey that you're seeing, the chart on the left, is done by Cushman, and they've shown, in fact, CBRE did a similar survey for their tenants as well. And we discovered that Asia Pac occupiers are less, should I say, positive over the alternative work arrangements. They are more likely to return to the office. You can see in China and Hong Kong rank quite lowly as compared to New Zealand and Australia. And that trend is likely to continue. What you're seeing right now, the social relaxation policies, people are getting back into the office. And in fact, the rental recovery we have seen in major markets, both in Singapore and increasingly in Sydney as well as in Perth, recovery in this market are quite strong and it's likely to continue, especially in Singapore, where the supply situation is quite limited to support the office market going forward. Another sector that we are positive over is the multifamily. Why do I say that? Well, if you look at multifamily, and this is really driven by, again, the same fundamentals, right? Structural shift, the whole urbanization story that we hear about in Asia Pac. In fact, just some quick numbers for you. In the last 10, 15 years, we saw about 1 billion people move from rural Asia into cities. Over the next 15 years, we're expecting another 1 billion to move from the rest of Asia back into the city center. So all that kind of urbanization, continued urbanization will likely to drive demand for homes in the cities. Already, cities like New Zealand, China, Singapore, the housing price to rent ratio is extremely high. And this has driven some of, very high demand for housing, especially rental market. In Australia, particularly, you see that trend more in Australia. Not so much in Singapore because we have a huge public housing market that kind of distorts the way the private rental market is behaving. But if you look at the multifamily markets in Asia, the key ones really in Australia and Japan. These are the largest market, and increasingly China, because of the government's policy to support the rental housing market, is seeing a lot more activities. And because of this positioning where they are, price to rent ratio is likely to continue to support the multifamily market going forward. So here you see the residential investment markets. The key markets really is in Japan, in dark blue, and increasingly Australia. So a lot of projects are being built right now in Australia, and we are positive over these two markets, and increasingly in China as well. So quickly, what are the risks? Right? As good investors, we need to invest, right? We need to take calculated risk, as George Payton said, and this is quite different from being rash. The key risk that we see right now in the market, first top of the line is geopolitical risk, right? And it's really, it started off with US, the West, and China relationship that kind of deteriorated. It really got so bad to the point that this is the worst you have seen for the longest time ever, right? And there was a tit for tat US diplomatic boycott of China's Winter Olympics, and then tit for tat China's impact on the US, impact on the TikToks, China's tech companies and whatnot. And increasingly, it's being exacerbated by China's diplomatic support for Moscow. And this really got to do with the Ukraine and Russia war that's ongoing at the moment. So this political risk is likely to lead on to inflationary pressures, already seen supply side pressures, as well as overall financial market will be hit if this thing continues, which means the climate for the investments are likely to take a backseat if that continues. The other risk that we need to look out for, as I mentioned, as alluded to, is the economic uncertainty, right? We have, first of all, China's weakening economic conditions has really been loudly broadcast, and we know that the People's Bank of China has been lowering interest rate for the first time in 2 years to support. So it's a very expansionary policies they're adopting in there. In fact, for those who follow the real estate market, the triple line, the red line that they did a couple of years back, which affected a lot of property firms. For recently, the government has kind of it didn't unwind, right? The Chinese didn't unwind their policy, but they allow certain new measures, new ways of lending to these property counters and property firms to support the liquidity in the market without being counted as part of the 3 red lines. So enough to say, it's basically face saving. Don't roll back the policies, but I allow you some financial support to this market. So there is a bit of that. The market is slowing down and it's likely to continue. If you look at what's been happening right now, the lockdown in Shanghai, all that will impact the market going forward. The other key thing to look out for is really, as I said earlier, the inflation, and that is especially in US and Europe. The situation has gotten a bit worse now because what used to be a COVID inflation, right, is driven by the revenge spending and recovery in the employment, right, in the US, has now been replaced by a conflict inflation because of supply chain as well as the rising oil prices. due to Ukraine and Russia war, this becomes a bit more difficult. How is the US central bank going to manage that remains to be seen. Because on the one hand, you have very strong inflation. On the other hand, you have a very depressive market going forward. Are you going to expand? Are you going to continue to raise interest rates just to cull back on the inflation and risk deflating the market? This is something that all the economists are watching very carefully. And some are calling that the US is unlikely to move its rate out after the second quarter. What used to be 6 rate increases may be pared back eventually. Who knows? The other one is, of course, the growing construction costs that I mentioned, and that's again due to supply chain disruptions, labor costs tightening. In fact, see some of the numbers here already. And why is that important? Like I said, many of the alternative asset classes, data centers, cold storage, etc., are mostly built to suit, meaning they're built for the occupiers. So if construction costs will go up, it's going to impact investments into these asset classes. For funds who are investing into this market will eventually be impacted as well.
So we're very excited about the market potential here, as we see that as of today, only $1 trillion worth of digital assets are in the market, compared to the traditional asset value of 1,100 trillion, right? And within that context, the real estate market is approximately 280 trillion. So we can see that if we were able to, make digital tokens out of this just within the real estate market alone, let alone all the other financial products that are available out there, the growth is just tremendous. Looking at institutional investor survey, actually what we've seen is that there's a lot of take-up within Asia for digital assets, and it seems like Asian-based investors have really embraced this. More than 70% of the investors plan to buy or invest in digital assets in the future, and more than 90% of them actually expect to have an allocation to digital assets by 2026. In the US and Europe, they are slightly behind, but they are expected to see a lot of growth as well in the next few years. So if you look at a building that's worth, let's say, $10 million now, it's probably a very small building in Singapore context. But an investor wants to participate in that ownership, but only has 10,000, right? So you typically cannot own a building within those kind of denominations. So what asset tokenization does is, first, it allows you to verify the asset owner, right? So the original owner of the building, for one. And then after that, it's transferred into the blockchain-based platform to the issuer of tokens. And the investors who buy into these tokens are then able to own parts of this asset. So the number of tokens is just issued based on the total value of the underlying assets. And in this way, you have a matching of the pools of investors with the liquidity from accredited investors or institutional investors and the asset owner. In the past, the building would have only been owned by institutional investors and not accredited investors. So why go through our platform? I think one of the key benefits is, again, we come back to fractional ownership, because you can now buy $10,000 or $20,000 worth of multi-million valued building, as an example. A lot of these traditionally illiquid products like buildings, because you can't trade buildings in the space of a day, right? Buildings are typically bought and sold over the space of a few months, because there's legal due diligence to be checked, titles to be checked, and a transference of ownership. So when you do this through the blockchain, actually you can trade what was traditionally illiquid assets. The fact that we are using smart contracts actually makes this process a lot more efficient in terms of distributing dividends and conducting shareholder votes. Also, because we are regulated by MAS, you know that everything is in compliance with MAS rules and regulations. And finally, the most important thing is the records are immutable, which means that there is no way you can make any alterations to the ownership once it's been fixed. So once you've been issued the token, the only way it will change is if you sold your token to someone else. There's very little room for fraud if all the information is actually kept on the blockchain technology. Thank you very much for your time and for joining us. And we hope to see more of you on our platform as members. Have a good evening.